Since the price of Bitcoin fell from $40,000 to $30,000 and then rose again, not everybody is pessimistic. The price drop in the Bitcoin spot market on May 19 wiped out around $7.56 billion in long-leveraged investments in cryptocurrency futures markets. Since March 2020, this was the largest bullish leverage wipeout. To boost their future returns, retail and institutional investors borrowed from major exchanges. However, bulls' leverage ratios were blown up by a swift turnaround in Bitcoin spot values, allegedly sparked by Elon Musk's anti-Bitcoin tweets over the weekend and fueled by China's reiteration of a ban on crypto transactions. In the futures industry, this resulted in a so-called liquidity cascade. Investors in conventional markets support their leveraged bets with dollars, but the cryptocurrency industry allows for Bitcoin-backed collateral. As a result, when BTC prices slip, bullish traders, those that have leveraged bets on higher BTC prices, are caught off guard. Many investors have tempered their bullishness in the Bitcoin industry as a result of the incident, with Scott Minerd, Chief Investment Officer of Guggenheim Partners, referring to cryptocurrency as tulip mania. The Wall Street executive has previously predicted a price of $600,000 for Bitcoin. However, the mind-bogglingly lengthy liquidation event hasn't turned anyone into a bear. Some experts, on the other hand, see the wipeout as a precursor to the next major bullish setup in the Bitcoin sector. For example, Twitter user, TwitterRTCL207, wrote a lengthy thread describing why he believes a decline in accessible interest has made Bitcoin better in the long run. The involvement of market makers in the operation of a cryptocurrency derivatives exchange was illustrated by TwitterRTCL207. During the May 19 dip, the analyst clarified how their tactics helped to move Bitcoin from weakened to stronger hands. The Bitcoin futures contract is usually overly long in hindsight. As a result, market makers want exposure on the bearish side of the trades. As a result, they create short positions. However, this does not imply that the liquidity suppliers are bearish. They choose to hedge their short bets by buying BTC or other bullish derivatives exposure in spot markets, options, futures, perpetual swaps, etc. TwitterRTCL207 stated, "There's hedged short demand hitting the market maker too, so that the market maker can sell their shorts back to them. But generally in crypto, it's long biased, and thus market maker holds. The spot is collateral to their shorts." Market makers purchase spot coins despite strong leverage demand from bears, according to the researcher, who also points out that leveraged long position investors are the weakest possible hands, and are more prone to liquidations if the spot Bitcoin rate falls. Market makers close their shorts against long liquidations in order to have liquidity. To stay impartial, they even sell their place spots. The investor summarized what occurred on May 19, when $5 billion worth of long bets were liquidated in 3 hours when Bitcoin's price plummeted from approximately $40,000 to $30,000. The BTC/USD exchange rate soon returned to $40,000, however. The open interest in Bitcoin futures, on the other hand, did not suit the spot price rebound. This means we just had the most significant weak hands to strong hands transfer in probably since March 12, 2020, tweeted TwitterRTCL207, adding that strong hands with real money purchased BTC from market makers for a low price. These coins have now transferred from short-term leverage speculators to real cash buyers, he said. Meanwhile, analyst Willy Woo stated in his most recent newsletter that the Bitcoin market's long-term outlook remained positive, reiterating what fellow trader TwitterRTCL207 stated in his Twitter thread. The coins are heading through the wallets of long-term buyers. A hodler in the Bitcoin industry is a long-term trader who sees the blockchain as a safe haven toward fiat currencies. Western central banks' capital injection programs, designed to mitigate the effects of the coronavirus pandemic on their economies, have sparked inflation concerns. For example, the Federal Reserve of the United States declared last year that it aims to raise inflation above 2%. The central bank has maintained a near-zero interest rate stance, purchasing $120 billion in government bonds and mortgage-backed securities per month. There is no need for Bitcoin to replace fiat currencies to maintain value completely, said Vincenzo Furcillo, an analyst at Seeking Alpha. He said, despite the potential for uncertainty, forecasts suggest an optimistic skew in the next 5 years. Bitcoin can be included as a defensive investment in the portfolios of investors seeking to protect against future inflation in limited amounts.